Introduction to financial responsibility. Financial responsibility in business refers to the ethical management of financial resources, ensuring that funds are allocated efficiently and transparently. It includes responsible budgeting, financial reporting, decision-making, and the ethical handling of revenue, expenses, and investments. An organization's financial practices significantly impact not only its sustainability, but also its reputation and relationship with stakeholders, including investors, employees, and regulators. Financial responsibility is crucial for maintaining the trust of these stakeholders and ensuring compliance with legal standards. The role of financial stewardship. One definition of financial stewardship. Financial stewardship refers to the responsible management of an organization's financial resources. It involves making prudent financial decisions, ensuring the company's financial health and contributing to the long-term sustainability of the organization. Good financial stewardship is vital to meeting both short-term operational goals and long-term strategic objectives. Prudent investment, making decisions that prioritize long-term growth and value creation over short-term gains. Budgeting and forecasting, ensuring that financial resources are allocated according to priorities and strategic goals. Debt management, maintaining a balanced approach to leveraging debt without compromising financial stability. 2. Key principles of financial stewardship. Accountability, ensuring that financial actions and decisions are transparent and aligned with the company's goals. Transparency, providing accurate and clear information on financial matters to stakeholders. Risk management, identifying potential financial risks and implementing strategies to mitigate them. Sustainability, ensuring that financial practices support long-term growth while safeguarding resources for future generations. Ethical financial reporting, importance of accurate financial reporting. Accurate financial reporting is essential for maintaining the credibility of a company. Ethical financial reporting involves providing truthful and complete information regarding a company's financial position, performance, and cash flows. It ensures that stakeholders have the necessary information to make informed decisions. Transparency in financial statements. Companies must provide clear and accurate financial statements that reflect their true financial health. Disclosure requirements. Organizations must disclose all relevant financial data and any potential risks that might impact their performance. 2 ethical guidelines for financial reporting. To promote ethical financial reporting, businesses should adhere to the following guidelines. GAAP, Generally Accepted Accounting Principles. Adherence to standardized accounting practices ensures consistency, comparability, and reliability of financial reports. IFRS, International Financial Reporting Standards. For international operations, IFRS offers guidelines to ensure transparency in financial reporting across borders. Avoiding creative accounting. Ethical financial reporting requires avoiding practices like manipulating figures or deferring liabilities to achieve favorable results. Companies must also ensure that their auditors are independent and objective, providing an unbiased assessment of the company's financial health. Budgeting and forecasting. The role of budgeting in financial responsibility. A budget is a detailed plan outlining an organization's expected revenues and expenses over a specific period. Ethical budgeting involves ensuring that the allocation of resources is aligned with the company's goals, values, and stakeholder interests. Resource allocation. Budgets should reflect the priorities of the organization and ensure that funds are allocated where they are most needed, avoiding cost-cutting at the expense of ethical standards. In times of financial strain, businesses must resist the temptation to cut corners in ways that compromise ethical practices, such as reducing employee benefits or circumventing environmental regulations. 2. Financial forecasting. Financial forecasting is the process of estimating future financial performance based on historical data, industry trends, and market conditions. Ethical forecasting involves providing realistic and achievable projections that help guide the company's strategic planning. Realistic assumptions. Forecasts should be based on reasonable assumptions and avoid overly optimistic projections that could mislead investors and stakeholders. Monitoring and adjusting. Forecasts should be updated regularly to reflect changing market conditions and company performance. Corporate financial responsibility. One definition of corporate financial responsibility. Corporate financial responsibility refers to the practice of managing the company's financial resources in ways that promote the well-being of all stakeholders, including shareholders, employees, customers, in society. It involves balancing the interests of various groups while maintaining long-term financial health and sustainability. Two key aspects of corporate financial responsibility: ethical investment decisions. Businesses should invest in projects and ventures that align with their ethical values and contribute positively to society. Ethical investments also mean avoiding industries or businesses that exploit people or harm the environment, such as tobacco or arms industries. Fair compensation and profit sharing. Employees and executives should be compensated fairly, with structures that are transparent and linked to performance, not based on unethical practices or unjust enrichment. Corporate social responsibility, CSR, and ethical investments. Organizations should integrate CSR into their financial strategies, such as investing in community programs, supporting environmental initiatives, and practicing responsible sourcing. The role of financial ethics in preventing financial scandals. Financial scandals, such as those involving Enron, Lehman Brothers, and Volkswagen, highlight the catastrophic consequences of unethical financial practices. Ethical financial management can prevent these issues by fostering a culture of accountability, transparency, and responsibility. Some key lessons from past scandals include the importance of accurate reporting. Inflating revenues or hiding liabilities leads to financial collapse. Accountability at all levels, ensuring that financial misconduct is not overlooked or ignored at the executive level. Maintaining stakeholder trust. Financial transparency helps preserve relationships with investors, customers, and employees. Challenges in business ethics. Business ethics faces several challenges, including conflicts of interest, when personal interests clash with professional duties; whistleblower retaliation, fear of retribution discourages ethical reporting; short-term pressures, financial targets may encourage unethical shortcuts; global ethical variability, diverse cultural norms complicate ethical consensus. Summary: in this module, we have explored the foundational concepts of corporate governance, ethical leadership, and stakeholder theory. These principles are essential for ensuring that businesses act responsibly and sustainably. Effective corporate governance, underpinned by ethical leadership, allows companies to balance profit-making with social responsibility, benefiting not only shareholders, but all stakeholders involved.